weekly hangouts with Mike and other traders that trade real money every week. We are going to try to find these traders for you, everyone. They are not easy to find because the real traders that trade real money that works in hedge funds and prop firms, they you typically are not as easy or eager to come and talk about their processes. I used to work in prop firms and in a small hedge funds, and a lot of my friends that we have approached, uh, it's not as easy as I thought it would be. Within the next few weeks, you'll have Danny coming. He works on the floor. We will have Dennis, he's an hedge fund manager. We'll have Kevin, who is an options hedge fund manager. We'll try to put together for the community every week some hangouts from guys that most of the time you've never heard from. Uh, they are pretty unknown in the industry, and the reason they are unknown is because precisely every day they trade real money for their funds or work for a fund or for a prop firm, and we'll try to have them share as best as they can. Remember, these guys are not presenters, they are traders just like us, and they are going to try to share with the communities. So today I'm going to try to just give you some feedback on for the past 20 years what I consider being the foundations of what it takes to be a trader, everybody, and a consistent one. We are going to make those sessions as informal as possible, meaning we are going to do them 45 minutes every week, and then it's all about you. It's all about your questions, your concerns, your what's going on in your trading, and me, Michael, or other speakers will answer your questions as best as we know, from our own experience. The presentation is going to be super informal, guys. I didn't even really did any specific slides. I have my slides from the prior presentation that you've seen on support and resistance from the 2 days event, and on how to master support and resistance and options, and use also options to define support and resistance with a 68 to a 95% chance of success. But what I'm going to do is very much my life experiences, and I think Mike will jump. Between Mike and I, we have almost over 51 years of experience combined trading real money every day. So I think you might learn a tidbit or two here. So how do I consider the pyramid of success in trading, and what it really takes to be a trader? See, there's three components to be a successful trader, everyone. The first one is mechanics. And most of the traders are good at mechanics. You'll be surprised, especially even the intermediate people that answered and the beginners. They pretty much get mechanics within 6 months to a year. What is a mechanic? Double tops, double bottom, cluster high, cluster low, higher highs, higher low, trend lines, support and resistance, shift of momentum. Although they make a lot of mistakes in support and resistance that you can hear back in the presentation that I did in the 2 days. If you guys are interested, it was pretty much just about support and resistance and how we overlay options probability from the option chance, even if you don't trade options. So the mechanics, whatever type of traders you are, whether you trade forex, options, futures, or penny stocks, there's mechanics. You need to be able to read charts, and that is pretty much the easy part for traders. Now, here's where the second part is the most difficult part that takes years and years and years of understanding of things that you don't even understand. It's money management. So the money management, okay, part is crucial, everybody. Crucial. And the money management part is the difference between you surviving the 2 years, because it takes about 2 years. That's why I said, I asked you in the survey, are you a trader less than a 1 year, 1 to 2, or over 2? Because usually if you have been doing it that long, over 2 years, and you've been able to, over 2 years, day in and day out, survive that without blowing up your capital, like most of the statistics where 90% of the people blow up their account, then you pretty much have gone through the learning curve and survived that. Doesn't mean you are consistent, but it means that you achieve a milestone that very few people achieve, which is the 2-year mark. We're going to start by the first circle of love here, which are the mechanics. So remember, there's 3 circles to be a consistent trader. So we'll call it consistency here. And then we are going to intertwine all the other circles. I suck in graphic, believe me. So here will be like, let's say, the mechanics, like I told you. This one, let's call it the repetitions. And let's take the 3rd circle, which is the money management. And the equilibrium of those 3 is going to help you be consistent. So the first one are the mechanics. And that's most of what everybody knows. So mechanics have to be, for me personally, when I do mechanics in trading, it needs to be replicable and consistent every day. It needs that my actions on every single day are consistent and replicable for me to achieve the highest probability of success on my trade. So what I do is, I told you on the previous recording we did on the 15 speakers webinars, I look at our support and resistance, and I look for shift of momentum. Most of the good traders, they look at their monthly, weekly, daily, 60-minute chart. And they'll do like me. On the 60-minute chart, I look confirmation of clusters of my zones with confirmation of cluster of price. Cluster of price is when you have a net buyer, net seller that happens at least 2 or 3 times, and it creates a channel. When you overlay that channel on your 60-minute chart and your weekly, where you go a couple of years back, you have a strong support and resistance with your daily support and resistance, which I have everything on the 60-minute chart. I have 27 zones. So you do that. Then you look at your watch list on the instruments that you analyze prior, and usually you should start your analysis between 7 a.m. and 8 a.m. if you are serious. Okay, because you want to be prepared and relaxed by the time the report comes if you want to trade the futures. Then what you need to do is look for the highest space between your support and resistance. Look for highest space between a support or resistance, okay, where you can do business. And I told you a little trick that I learned a long time ago is, if you have a range on your support and your support and resistance again can be anything, as could be your moving average, it could be your market profile in your case, it could be Fibonacci extension and retracements, it could be cluster high, cluster low, it could be anything. I don't care what you're using. But the bottom line is, every trader coming in the morning have some type of a support and resistance, and especially the professional ones. Does that make sense, everybody? Yes or no? So what you want to look is the highest space between that support and resistance on the instruments that you use, which are going to give you the maximum rate of return for your capital for that day. If you trade, or you do options, or even you do credit spread and sell time decay. So you look for the higher space instruments. So what you do is, by 8 o'clock, okay, you should have zoomed not only your analysis on all your market. We analyze SPY, ES, NQ, the Dow. That's the minimum. Okay, Apple and Google. That's it. That's my minimum base. That I can day trade and do also weekly spread with that. When you have that minimum space, everybody, then what you want in your mechanic is make sure you understand, like everybody, what is a real double bottom, a real one, not a fake one. What is a real double top, not the one, and what is important in the double top and the double bottom for the shift of momentum on your support and resistance. You want to understand the head, shoulder concept, and when the shoulder is broken, where it can go for another high. You want to understand the inverse head and shoulder concept. So those are for the shift of momentum. In the mechanics, when you have all of this in path, you have to decide, am I going to trade futures for the day, forex, penny stocks, right? How am I going to allocate my capital? And what is the strategies that works the best for me and my capital? Which usually for me, it's options. I do very small gamble trades with penny stocks also sometimes, but mostly options and futures. Okay? So you have to overlay the mechanics. Okay? I'm not talking about the money management yet. I'm talking about mechanics. So what is a real, someone is asking, what is a real double bottom? A real double bottom is as follows. If they make a first bottom here, where I circle, they have a tendency of knowing that the professional, not the professional, the retail public put their stop loss at the lower level 1. So what they do is they run your stop loss through, they push you a little bit lower. When they push you a little bit lower, then they start uh, reaching a neutral point where the tapes start hooking back through the zone, the prayer low. That's where your double bottom starts. And the double bottom is confirmed on here. So you enter here when it recross X1, but you add to your double bottom when it recross the middle of the double bottom. Same on the double top. Same on the double top, everybody. Does that make sense? And on the head and shoulders, everyone, on the mechanics, just on the mechanics. So remember, 3 circles of balance to be a consistent trader. Mechanics, money management, and repetitions. And that create consistency. Then you have the head and shoulder. The head and shoulder, you have to be careful because that level right there is the shoulder. They create like a double top. So now it looks like a double top. They recross that level, but they go and retest that level one more time. You want to make sure that that level holds as a lower high from this one, otherwise they go again and it becomes another double top. So those are mechanics. And mechanics are easy. Most of the traders understand mechanics within the first 6 months to 1 year of trading. But what most of the traders fail at, everyone, is to overlay those mechanics with the other circle, which is the money management. Do you guys have any questions on the mechanics? Again, you come, you do your daily routine. You look for space between support and resistance. I gave you a trick last time on the today's webinar. If you have a support and a resistance of 9.1, the way I used to do it on prop shops, we were in prop shops. I learned that in prop shop, not in my hedge fund. But they used to divide the range by thirds for statistics. So if you had 9-point range, you divide it by 3 points here, 6 points here, and then it goes to the last third. And if you enter along and there's a recross here, so I may take another pen because that's becoming a lot of same colors here. If you have a recross here, blue, and a retest, you want to take that long here within the first third when you divide your third. That's a good trick. And that's not taking any day trading zones that we do or stuff. It's pure logic, everybody. Pure stuff that you can have on your chart, on a blank chart. You know, you look for that recross of your Fibonacci lines, your EMAs, your profile, whatever you use, okay, that creates those support and resistance. Divide them by third if you trust them, and then what you want is make sure you do not chase more than 1/3 of the move on the long. If you go on the second third and you are chasing along here, you are going to lose money. You have a 50% shot. If you go on the last third, you have only 33% chance of making money. So when you divide important support and resistance, like a weekly or monthly, you divide them by third and you enter the first third. Guess what? Now you put yourself into a 66% chance of making money. The key is to put the stop loss here on the low, on the prior low before the test of the support. Does that make sense, everybody? Quick yes, no. It's very simple mechanics. So we can move on to the money management. But again, it's all about simple mechanics. And then what you do when you overlay those mechanics, everybody, okay, you move on, okay? And I told you in the previous event when we did the support and resistance mastery event, Michael, you have the link somewhere? I think.
Yeah, I put it in. Let me put it in again.
Yeah, that was the replay of our last event when we had the 15 speakers. You can listen exactly how we construct support and resistance with the setups, and also how we use option chains, even if you don't trade options, to create support and resistance on stock ETF and your options trading that are very strong to increase your probabilities at 66 to 95% chance of success. So now that we looked at the mechanics which most traders, I told you, control, now is the tedious part. Now is the tedious part. The tedious part that nobody wants to hear. Part of your pyramid, everybody is going to look like this. When I first started and I was in prop shop, what the prop shop make you do, number one, is make you pass your licenses, Series 55, Series 6 and 7 at the time. And at the same time, they teach you to use the platforms. The platforms, your chart, your execution platforms, they make you train on it for 3 weeks. So for 3 weeks, and the reason I want you to know what prop firms are doing is because those guys have a business. And if I can show you the processes that I went through as a business, then it can help you to structure your own business. Does that make sense, everybody? Because this is a place where 90% of the people lose money. So you want to understand what are the other 10% or 15% doing to have a transfer of wealth, to take that wealth from you guys. And they are doing the steps that most of the retail traders are not willing to take, everybody. So what happened here is for 3 weeks, they want you to know your chart provider and your trading platforms upside down and inside out. And the reason being is because a lot of traders will lose money, even if you are a good trader, not knowing how to flip your charts quickly and not how to not only flip your charts, but not be able to use your execution platforms. You know, you'll put a buy order or stop order, you'll screw up. Who has ever screwed up doing this? That should be about 100% in the room, including me. You know, there has been many times when I started a platform like Thinkorswim or Interactive Brokers and screwed up. So you have to let yourself the time to really master your platforms. Also, during those 3 weeks where you do the licenses and you master your platforms and you master your charts, the prop firm is going to start putting you on the sim during those 3 weeks. And the interesting thing that I always found it interesting when I traded on the prop firms is even though you come with a track record, they'll put you at least a week on the sim and they'll make you trade 100 shares. They'll make you trade 100 shares. When you pass the sim period and your licenses and the 3 weeks of mastering your charts and your tools, they are going to give you still 100 shares to trade with a 25-cent stop loss at the time on the Nasdaq stocks I was trading. Then I traded futures and options for prop firms. But here's what happened. What they are doing essentially is gradually build up your muscles. So they are gradually building up your emotional muscles and also your financial muscles. Because the analogy that I take is, would you go at the gym? And I am not like a big guy, but I'm pretty fit. But I'm not a big guy like with huge muscles. If I go at the gym and I start lifting up like 180 pounds, 200 pounds for the first time, I'm going to get crushed, everybody. And that's the problem of most traders. Traders get crushed. They come in, they have $30,000 available, $15,000 to $30,000 available, most of the people, okay? And they get crushed. They start with sizes that are way too big for their surviving journey. It's a trading journey that will take you at least 2 years. And if you are not going through that trading journey with small sizes, there's only one outcome, and one outcome only. I'm telling you today. You better give your wife the money to go at Club Med or to go and give it to your church. Because what kills trader, and it took me not long when you trade professionals, but I see traders that have 10 years of experience, 5 years of experience, even 20 years of experience that still not get the concept of gradually improving size, and always have risk management parameters that are going to keep you in check. So what they did is they gradually improve you from 100 shares, then you prove yourself 125 shares, then 150 shares, then 175 shares, then 200 shares. Then when they start seeing you manipulating pretty good 500 shares, then they jump you 1,000 shares. Then 1,000 shares, they gradually improve you again. 1,250, they go by 1,250, then 1,500 shares, etc. And this process for some traders and prop firms, everybody, might take a year, might take 2 years. And as you can see, because prop firms, traders which works in professional trading using the firm's money and have a split, they don't make a lot of money because it might take a year or two before they can even trade big size to make money. That's why when I finally reach a comfortable level of capital, I left and I traded on my own most of my life now with my own funds. So you have to gradually improve that muscle memory, everybody. So on the money management pyramid of success, when you gradually start small size, the key question is what is a small size? And that's the big question. The big question mark for everybody is what is the optimum size? Does that make sense? Right, Michael? What is the optimum size for my account?
Yeah, that's the key. Yep.
And is there anything you want to say on the stuff I've already said?
No, that's good. I'll jump in a little bit later, Mark. Sure.
Okay, so on the optimum size, there's a very simple formula that everybody can use and should know of. And unfortunately, a lot of traders do not know that formula. It's called the amount at risk that you're going to take on this trade. So the amount at risk, usually it's a percentage, everybody. So if you have $100,000, usually it's 1%. So equal $1,000 on a $100,000 account. Okay, if you have 10,000, it's $100. That's why when you trade ES, the optimum stop loss is 2 points because you have only $10,000 a contract. And the reason you want to risk no more than 1%, it allows you to have 100 bad trades in front of you. Unfortunately, a lot of people, especially on the E-minis, they come in and they trade with $500 margin. They risk $100, and guess what? Now they just risk 25% of their money. So, or 20% of their money. 20% of their money, 5 trades, you're gone. The entire capital is gone. Does that make sense, everybody? So what you have to do, the simple formula, and it works for options, it works for Forex, you have to readjust the tick value, okay? For Forex, for futures and options, is the amount at risk, percentage-wise, usually 1% if it's a day trade, in and out, for the weekly buy, put, and calls, and the futures. If it's selling time decay in options, it's completely different. I do it differently. So amount at risk divided by the stop loss. And your stop loss should be from your chart. So again, I use my own tools, but you guys have your own support and resistance, and your stop loss should be derived from your chart. So again, look on the right. If you have a support here, you have a resistance here, and this is 1600 on the ES, and they went to 94 here, and you enter the trade, it recross, it retests the 1600, you enter the long here, and you put a stop loss at 94 on the previous low at 6 points, or whatever. Okay, and then guess what? You're on the first third of the move, then to let's say 1630. Okay, so you're still in the first third, 10, 20, 30. So when you do that, you look at your stop loss here, then it's 6 points. Well, if it's 6 points, how many contracts are you going to take if you have $30,000? So you have $30,000 available. 1% at risk on your E-minis is going to be $300 at risk, divided by your stop loss 6 points, and then it's giving you what? The maximum numbers of contracts you can trade safely on this ES. And guess what? It shows you 5 contracts. That's it. That's it. End of the story. You take the stop loss, 1% of your entire capital available divided by the amount at risk. 1% of your $30,000 divided by the stop loss on your graph. You have the optimum, maximum size that you should take for your contract, for your size. Does that make sense, everybody? Quick yes, no. It's simple, it's dirty, but guess what? Only 10% of the traders do that every day religiously. And again, on the pyramid of what it takes to be a trader, you have three stools. Remember? And that center stool here, which is your money management, supports everything. It's your foundation of everything. A good someone who is bad at mechanics but great at money management with small size will outlast and beat the guys that are great mechanics, you know, great repetition of the move but very bad money management and always blow up with big sizes. Does that make sense? Always do that formula. So again, you build up the size. You have the formulas for the optimum size and the optimum amount at risk. And that's it, guys. You know, people say, I'm going to ask you at the end of the session, what is the biggest hurdle that you have as a trader? And it'll be interesting to know because a lot of people say psychology, discipline, blah, 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 and all that BS. The reason to me it's BS is because if you enter trades with small size, and I'm very passionate about that because it took me, I have done it 20 years, and even 20 years after, I'm like, shit, this trade should have been with a smaller size, right? Sometimes I enter an Apple and a Google 2-4 contract. I'm like, shit, this trade should have really stayed at 2 contract. Okay? So even 20 years later, I know that the nerve of this war that you are fighting, the nerve of this consistency that you are reaching and looking for in your trading journey, everyone, is size. Everything is size. Is the amount at risk divided by the stop loss, and that's it. The amount at risk that you are comfortable to lose divided by the stop loss on your chart, and you have the optimum size. And this is the key, the nerve of the game here, everybody. Everything else is BS. Everything else is BS because people can be great in mechanics and they screw the money management and they have a great system that gives them a 80% win. But guess what? Because they have big sizes, when they lose, their percentage win and their percentage lose win doesn't mean crap because their average win and average loss will bury them down on their lifetime expectancy as a trader. Does that make sense, everyone? This is very cool stuff and it's very profound. You know, a lot of people, they want to sell you the magic pill and blah blah blah, and my trade setup that works all the time. Yes, there's trade setup that I use that works, but you know what? If you still do them with the right size, you'll be buried alive. You'll be buried and you'll be dead. I don't care how you slice it and dice it, everyone. Okay, so let's move on to the last stool and I'll be done for the day. See, we want to do those hangouts very quick, guys. Like you are fast, you get like tidbits that are precious. 45 minutes, questions and answer, and it's all about you. You know, after it's answering individual stuff, we'll give you the biggest hurdle that you want to overcome. And remember, every week we'll try to do that again with prop traders, hedge fund traders, people on the floor with Danny and his crew, and give you guys like real value. And we will not, we don't, that's it. And just give you the maximum value that we can give the community so that you can help yourself extend your trading journey here. So now the last one is the repetition. It's key because a lot of the stuff we talked about, which are the mechanics, okay, the money management, you need to repeat, and that's the hardest part. You need to repeat day in and day out. Like any business in life, like anything that takes a little bit of sacrifice to achieve great success in life. And again, why is that 90% of the traders lose money? Is two reasons. The reason one is because they don't know what they don't know. It's like me when I go at the gym and like for what 10 years I was doing martial arts and I was fit, but I never really could get big muscles. And then one day I stumble and I say, you know what the heck? I'm going to ask that guy at ask that guy at the gym, Michael, why he has big muscles. What does he do to have big muscles? And the guy started telling me, and you'll see how it's profound because it's the same in trading. The guy started telling me the reason I have big muscle is because I do 5 reps on my biceps, 5 reps, and I'm starting at 25 sets, and I go down to 8 sets, and I do 5 sets, and then he tells me, the guy, I eat 8 times a day proteins and carbs. And I was like, wow, really? You eat a lot of carbs? I said, like me, I don't eat any carbs. I just eat proteins all day long with salads and stuff and eat healthy. And the guy tells me that's why you are not getting bigger because you don't get the carbs. And so the light bulb came up and I was like, wow, this is one of those things again like golf. Unless you talk to someone who has been there and done that before, how are you supposed to know, everyone, the stuff that I just told you? Does that make sense, everybody? So the number one reason why trader fails is they don't know what they don't know because of lack of experience of reaching that goal. Okay? And the second part of why trader fails, I told you, and the main part is it's not so much the mechanics, it's the size. As the size is all that simple, consistent routine. You know, some people can be great at doing a diet for 2 weeks, but then you explain to me why someone does a diet for 2 weeks and screwed up his diet on week 3, week 4 is because they are not able to do this, everybody. And that's everything else in your life. The way you eat, the way you treat others, the way you run your businesses, the way you do everything is the repetitions. What are the successful repetitions that I need to do day in and day out? We talked about it already. The mechanics and your daily routine. The second thing that you need to do every day is make sure before you enter the trade, before you enter the trade, you know the worst outcome. Your risk is extremely defined. You know how much you risk, your max size, right? You know your maximum amount at risk and your stop loss. Like I showed you, amount at risk percentage divided by stop loss from your graph. And you do it every day, not one day, not one trade, not 3 trades out of 4, not 4 trades out of 5, because the one that you don't do it on is the killer that will blow up your month. And you do it consistently and systematically. And now to perform your repetition, it's like going at the gym, it's the doing. You got to do it, guys. So again, the way we were trained in prop trading firms was 3 weeks. You learn inside out your platforms and your execution platform and your chart system. Even if you are a 20-year trader, each time I change platform or charts, when I go with real money and I don't give it enough time to master it, and still I don't master it to this day, I get screwed. I screwed up an order entry, I don't flip the chart fast enough, I screw that up. Then you go for 3 months on the sim. Yes, 3 months on the sim. Because here is what happened. You got to get out of the sim, everybody, within 90 days. Absolutely, because otherwise you'll never get out of the sim. You'll spend your life on the sim. And the emotions on the sim and not the sims are not the same. But my take here is very different to a lot of guys. Is that if your strategy is not proven successful on the sim, so you have to track. Everything needs to be tracked. Your entry, your time of entry, so you can look on your chart at what time you enter to replicate what you've done right or wrong. Your exit, your exit time, your commissions, your rate of return, including commissions, your ROI on your options, especially how much margin requirement is necessary with my profit. You got to have metrics for everything that you do, guys. That's why, like me, when I trade, we have spreadsheet for everything. You know, so you monitor everything, your percentage win, your percentage loss, your average win, your average loss, your entry time, your exit time, your return on investment, your margin. And everybody is going to say, whoa, this is too difficult for me. And the guys that are leaving this room and say they are too difficult for you, fine. You know what? Those are the same guys that tomorrow, and I don't say that just to be a jerk here. So we're trying to do real traders webinar, real traders, real no BS stuff. Those are the same guys that tomorrow morning are going to give me their money. Does that make sense, everybody? Those same guys that are not willing to perspire a little bit and go the next level. If this is really something that you guys want to aspire to, you got to do the steps, everybody. There's no shortcut. There's no shortcut. Everybody that promises the shortcut is BS. Someone who has been there can show you the rope. Like that guy at the gym that shows me how to get big muscles and gave me the light of what I was supposed to do and what I was doing wrong and put me on the right path. But ultimately, you will be responsible for the repetitions and doing them every day. Right, Mike? If Mike is here, he can add to this.
Yeah, well, I'll add next time, Mark. We're at our 45 minutes, so if you want to take a couple of questions,
Okay.
already it goes by quick.
Okay. Mike and the time, guys. Okay. So these steps and over the next few weeks, every week on Tuesday or Thursday, guys, night, we will go with another speaker that trade real money, and they will give you their tech, and they will help you on what works for them. And a lot of the strategy that I use around support and resistance was already explained on the replay from the 15 speakers webinar. Mike, if you want, post the link so everybody can listen to that. And you will see if that can help you to understand the strategy that you overlay over all of this. So now I think it's going to be all over about your questions, guys. Okay, so an example, someone said, can you make an example of what you're talking for a long or short for position size? Well, let's say you have a $10,000 account, okay? You have a $10,000 account right now, okay? And here's what happens. Let's say this is my support, and actually it is my support on my tool, so it cross, recross, retest. So let's say you want to take Google at 865, let's say 866 area. So what I would do with a $10,000 account is how much am I willing to lose with the 1% or 2% rule. So you are willing to lose $100 or $200. Pick and choose. If you want to use only 1% of my account, remember, so your capital available is 10,000. Now you are going to take your amount at risk divided by your stop loss. So 1% is $100, 2% is $200. Now here's what happened. I look at the stop loss that makes sense, and I told you I want that low here. So let's say that low was what, on 613. Can you give me that, Mike? I guess I'll fish it for myself. So let's say it's 863. 863 from my entry is a 3-point stop. 3-point stop. So if my stop loss is 3 point, 3 point, now here's the formula for the optimum size. 100 divided by 3, that's 33 shares. Yep. And here same. 3-point stop loss, you take 200 divided by 3, that's about 66 shares. And that's it. That's simple. So if you lose 3 points on 66 shares, you are going to have more or less just shy of 200 bucks. And you will be 2% of the $10,000. Do you understand, Didi? That's it. That's it. Nothing else, really. Nothing into it. That works for, yeah, you're welcome. It works for options, it works for stocks, it works for futures, and it works for Forex. Anything. So let's see, James. Sorry, I missed your questions. Guys, if you posted the questions that I've not answered, post it again because I'm answering the questions right now. Okay, James, not sure what you're saying. I was taught. Do you understand what James says here, Mike?
James, I was taught to use the 70, looks like 70 cents times the cost of option would be a good place for a stop, but when I use that a lot of time, I end up losing 30%.
I guess what he's saying, and correct me if I'm wrong, James, I think what he's saying is that he places his stop at 70% of the premium.
Yeah.
So if he has a premium of $1, he'll put his stop loss at 30 cents. Is that what you're saying, James? Yes, no? Okay. Yeah, that's a tough one with options, James. Are you talking about buying them here, I'm guessing? Because that's not a spread question, correct? It's when you buy a put or a call on your weeklies? Quick yes, no? Okay, cool. Yeah. So that is a tough one here, James, because typically me, when I enter my trade on SPY, and again, I'm a big believer on options that you should master SPY before you venture on the Googles and the Apple and get crucified. That you, if here's my take: if you cannot control the SPY options, you'll never control ES and you'll never control Google and Apple. So the best place any traders can start and even perfect being the best. I have some friends of mine. They have been trading 20 years plus like me, and they work for hedge funds, and they only trade the SPY options and write uh, uh, time decays on the indices, the SPX, the NDX, the QQQs, the SPY, and the IWMs. So when I buy them, James, I typically, if I am in front of the screen, I typically do not put a stop loss because I know that the market makers within 2 hours they are going to fish for it usually. And when I am not in front of the computer and the move is going, I put a 50% of my entry on options. That's where you adjust your size. If it's an SPY trade, if it's an SPY trade for a day trade and you time it well with good support and resistance, usually I'm able to make 20-cent stop loss on them because I want to make sure that I stay very close to trading the ES when I trade the SPY. Okay, so it's a very difficult thing, you know. I think again, if you get stopped 30% of the time at your 30% here, James, is because it's a timing issue, you know. Because 30 giving away 70% of your premium is a pretty big distance. Does that make sense? And if you are going to do that consistently, you need to make sure you apply the formula we gave you on adjusting your sizes because you'll get crucified if you do big sizes and lose 70% of your premium on a consistent basis. Uh, other questions, let's see. Guys, slow down the questions. I'm coming. Greg, credit spread controlling risk. Wonderful question. I love credit spread. If you look at the day trading zones here on Google, they went from 865 dash to 904, which is pretty much a 40 points after a cross recross and a retest of two dashes. You had two cross recross and a retest higher low. Cross retest, cross recross, retest higher low number three here, and then they went to the next dash, cross it, retest it again, number three, and boom, 33 points or whatever. So the way you do the credit spreads is when you have a strong support and resistance confluence here, let's say 860, 870, you go like, let's say 3% below that, you know, and you use like maybe 20 points or 15 points on Apples and the Googles, and you do like the 850, 855 or whatever it is, and you do your spreads out of the money. When you control your risk already, Greg, when you enter your spread by you looking at your support and resistance and make sure that your delta or your probability to stay in the money in your puts or above or below your puts and your calls are between 68% and 95%, which is in the bell curve, one or two standard deviation. This is where you have the highest chance of making money. But don't forget, sometimes you sell spread at 68% chance of success, and even that you might be tested at 66% chance, and this is where you have to make sure you don't freak out, where your puts and your strikes are being tested and you start losing money, and most of the people they freak out and they get out of their spread with a loss, whereas you have to stick through thick and thin if it makes sense on your charts. And then if you still lose money and it approach expiration, then what you do and what I do is I roll them over for higher premiums, so I have a positive. So if I have a negative 30 cents here, fine, then I roll another one on Google and try to make 45 cents, even if I lose 60 days or 30 days where my capital is tied up for an extra 30 days or 60 days, but the overall position will make me 15 cents. And a friend of mine, that same friend that works in the hedge fund industry for options, that does the SPY and the indexes, they only have 6 to 7 lost per year doing thousands of trades. And the reason they have only so few losses is because on all their losers, they roll over on their spreads or their naked puts. The only problem with rolling over is you tied up capital for a longer period of time. But that's it. But at the end of the day, if you are patient, you are not losing. Next. Mike is giving me a sign. It's over an hour. Yes, we know. let me let me see if we can answer some questions, and then we'll wrap it up. The reason Mike is there on the time is because we're, like I said, this format we are really trying, especially also for the recording for everyone, to keep them as tight as possible. And ideally it should be 35-45 minutes event. So it's like a blast of knowledge, quick, from people who does it. Uh, Let me see, Scott. Okay, so Scott has a great question. Great question. He says, with options, how do you do from a psychological standpoint when you have five losers in a row, and then finally you 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 know you're going to take that trade and it could be the big gainer and blah blah blah. Well, I think it's all line consistency of your actions every day, your repetitions of your daily routines, Scott. For me personally, I do 3 trades on options per morning. And it works, it works. It doesn't work, I don't give a shit, I'm out. And the reason being is I don't have that mentality of, oh, the next one is the big gainer and the next one is the big loser. To me, I come in with the mentality that every day has a lot of opportunity. And if today is not my day, obviously, if you have 3 consecutive losers, if today is not my day, so I'm fine. I lost 1% 3 times. I lost 3% of my account 3 times, especially in options or in futures. It's very easy to come back from. But the problem is most of the trader, Scott, what they do is they don't stop and they don't stop and they don't stop. And that 3%, before you know it, right, Michael, it becomes 30% of their account for the day.
Yes, yeah, and that's hard to come back.
Yeah, because a 30% loss in trading doesn't take a 30% to come back. It takes you like an over 50% to come back. So you have to be very careful, guys. Like if you have a $10,000 account, people don't realize that sometimes when they are newbies. But if you have a $10,000 account and you go down to 5,000, people think, oh, I lost 50%, so I need 50% to come back. No, wrong. Now you have 5K. How much percentage do you need to come back at 10K, everyone? How much? Let's see who is awake still. Yeah, exactly. 100%. So if you are down from 10K to 5K, it doesn't take you 50% to come back, guys. It requires staggering rate of return of 100%. And it's very hard to come back from when you lose 30% or 50% of your account. As a matter of fact, this is what I call the last blast, where the trader starts doing revenge trading. Big size, they say, shit, I have to recoup my money absolutely. Next thing you know, the 5K is 2.5K. Isn't it everybody's trading story in this room? If you've traded long enough, you've gone through this scenario. And believe me, or you've gone through it on one of your accounts, or you have not been trading long enough. Right, Mike?
Yeah, yeah,
It's pretty much the path, everybody. You know. Another question. So hopefully it helped you to understand that, Scott. I'm very systematic. 4 hours of trading every day in the morning. Trade from 8 a.m. to 12 noon Eastern time. Three trades per day. Win, lose, I don't give a shit, I'm out. I go and smell the roses and do other passions and other income producing activities for the day. You guys, how you, and we'll see you next week on our next week's Hangout. Thank you for being here, everyone.